And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country. Good evening. Welcome to the program. I'm Stephen Grootes, 8 minutes after 6 tonight. You get that kind of day after a public holiday where actually everything starts to move again and actually quite a lot of news about. Part of it, of course, due to trade. The president saying sort of Monday night, Tuesday night at the United Nations General Assembly that trade is being weaponized. I don't think he quite realized at the time that Taiwan was literally about to use microchips as a weapon against us. And we spoke about this last night on the Money Show, that microchips are very useful for Taiwan. They're literally the world leader in it. They're able to actually use that as a trade weapon. What I did not expect is to wake up and find out that overnight they'd rescinded their ban on the export of microchips to South Africa. So first they said you would not be allowed to export them here. Now they say, well, actually, we're rescinding that. I mean, it made me think a little bit of, when you're in a negotiation, you have a big weapon, the threat of the weapon is more useful to you than the weapon. It's a very strange story. We will unpack all of that in just a moment. Dr Azar Jammine will be with us. Donald MacKay will talk to you. Also, Dr Kingsley Makhubela, the former ambassador, he's been looking at this issue as well. I find it fascinating because trade really now is getting to the heart of relationships between countries in a way that it didn't before. Looking forward to a conversation with Ethos Capital. I should just remind you, they actually own a stake in Prime Media, which owns, well, yours truly, that owns this radio station. But they're reporting their results today. And then, I couldn't quite believe it. I had to check the headline about 3 times. Investec, the bank, has an energy trading license from NERSA. And there's another headline today that Vodacom has a virtual wheeling platform, which I know sounds like online gambling, but a virtual wheeling platform is actually the ability to buy and sell electricity from one point to another. You produce it in one place and you can consume it somewhere else. Why are cell phone companies and banks getting involved in electricity? And it reminded me a little bit of the kind of link that you see between banking and cell phones and how your cell phone network and your bank are really quite similar in an interesting way. 10 after 6.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM, streaming on the Prime Media Plus app
and DSTV channel 856.
So I wonder how you feel, well, I know how you feel about paying traffic fines. My question really is, when and how often do you pay them? And it says quite something that I can go on the radio and tell you this. I look at paying traffic fines only when I need to renew my license disc. It's the only time that I actually go to check. And I was thinking about, how do I do it? Well, some people use Fines SA. Some people go and do it on your bank. I usually tend to do it on my bank if I can. There is the R2 website as well. And I think more and more, as we try and sort of reduce our kind of interaction with government, and isn't that a terrible thing, you'd rather go for the kind of private sector interface, no matter how it works, because you know that you'll be able to do it on the website and it will be done quickly. Now, look, if you ask me, under the law, they say you have to have a license disc. The license disc serves no earthly purpose. No one checks on the address, and it really does nothing. It's not like anyone checks or roadworthies the car in any way, shape, or form. It is, frankly, and let me just be clear about this, it is just revenue for the province. So, frankly, we should do away with them. But I was interested. Sometimes, and it's happened to me, I'm sure it's happened to you, I've been stopped by a police officer. They say, you were speeding. You say, oh, I'm very sorry. They say, I could fine you for that. And I say, I know. They say, or you could buy me breakfast or cool drink money. And I say, well, I'm not going to do that. We can go through the fine process. And then they shake you by the hand and wish you a good day. It's a very strange thing. That's been my experience. And I realize because of my identity, my experience might be different to yours. But I would just like to know how you pay a traffic fine and how often you check what fines you have. I must just say, coming out of Sandton every evening, about 2-3 nights a week, there is a stop. They check, off we go. Once in the last sort of 13 months or so, I've been stopped at a very big traffic, at a very big sort of traffic roadblock, and actually had to pay fines that they had accumulated, and you take your credit card and off you go. Traffic fines, how scared are you of them? 011 8830 702 021 446 0567, and your stories on voice notes, please, on 072 702 1702.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, that comment this week at the United Nations General Assembly from President Cyril Ramaphosa, he put it quite nicely. I thought that trade is being used as a weapon. So many features to his comment. The actions of the Trump administration, I presume, is what he was talking about. The fears that AGOA is a dead duck, and decisions by Taiwan this week, first to curb the sale of microchips to South Africa, and then overnight to remove that curb. In other words, that ban is no longer in place. Well, we start your coverage of all of this with Dr Azar Jammine, Director and Chief Economist at Econometrix. Azar, good evening. In an environment in which trade is being used as a weapon, when things are changing so quickly, when trade policies are almost impossible to understand, over the longer term, I presume this would make the entire world a little bit poorer.
I would imagine you're absolutely correct, Stephen. And the main reason is that you've seen the evolution of an environment of such uncertainty that the willingness to invest and trade is actually quite in a lot of trouble at the moment. There's a huge amount of uncertainty. And it all started with Donald Trump switching from imposing very high import tariffs and then rescinding those and then reintroducing some at different levels. And we see changes almost on a daily basis. And now you've seen this in the case of Taiwan relative to South Africa. And it also began with Trump starting to impose punitive barriers on the likes of Brazil, especially because of political factors, but also India and to a lesser extent maybe South Africa.
Our Trade Minister Park Stow, he was on Bloomberg on Tuesday night at the UN, and he said he's still confident that AGOA could be renewed. Now, I understand why AGOA is important to certain sectors of our economy, but when we face the tariffs that we face from the United States at the moment, does AGOA still matter?
This is a huge question that's been asked ever since Trump imposed that 30% tariff on South African exports of automotive and agricultural products. And really, in theory, it wouldn't matter at all because the moment you, on one hand, you let a country like South Africa export things without any tariff, and then on the other side you impose a 30% tariff. It just makes no sense. The two are totally contradictory. But you've got to remember that AGOA is broader than just South Africa. It encapsulates a lot of other African countries as well. So I don't know whether that complicates the issue still further in terms of answering your question.
We keep sort of being given glimpses of hope. We're still negotiating with the US. This could change, that could change. I kind of wonder at some point if we're just going to, as awful as this sounds, have to make peace with the fact that this is whatever the final tariff settles at, this is what it's going to be for a while.
I would think you're absolutely correct. But I also want to make the point that I think South Africans are getting far too carried away with giving this as such a high profile. There are far more important economic influences in the country and issues that have to be cleared up rather than just our trade with the United States, which is actually, and what is being jeopardized is really just 30 to 40% of our exports to the U.S. because by value, the major portion of our exports is free of tariffs. Critical products such as PGMs and ferrochrome and titanium and that sort of thing. The United States is not imposing tariffs on those because it needs them. So, but there are many other issues. The fact that we are just not attracting enough investment, whether from local sources or international sources, that is of far greater importance. Yes, the two are related, but I think far too much attention is being paid to these trade negotiations, and it's detracting attention away from more critical areas of economic need that need discussion, including corruption and state capture and criminal syndicates and that kind of thing.
Dr Azar Jammine, appreciate the time. Director and Chief Economist at Econometrix, you with the Money Show, 18 after 6. Donald MacKay is the Director at AGOA International Trade Advisors. Donald, good evening. Ramaphosa's comment that trade is being used as a weapon, I mean, he was talking about the Trump administration, I'm sure. But if you look at what Taiwan is trying to do over microchips, first they ban the sale to South Africa, then they sort of unban it. It's not just the US now, is it? Other countries are doing the same thing.
Yeah, good evening. Trump has definitely set a bad example for pretty much the whole world, it would appear. I did think the Taiwanese action was quite surprising. I'm guessing it's related to the pressure to move their offices out of Pretoria to Johannesburg. But then they've walked it back again. And this too feels very Trumpian. Just do something today and then change your mind tomorrow. So lots and lots of uncertainty, which is just a bad thing for everyone.
In a way, while we're pointing the finger at Trump, and I think that's correct, but hasn't this all been a long time coming because of issues around the World Trade Organization, other issues that were supposed to create a set of rules that would govern all trade, when in fact the world is sort of, trade blocks have been kind of breaking up in a strange way, partly because of the US?
Yes. So between the US and China, they've largely broken the WTO. We'll have to see what emerges out of the ashes, but as it stands at the moment, the WTO is largely dysfunctional, which is not a good thing at all. And of course, for bodies like the WTO to work, they don't have a police force or an army or something that can enforce these rules. They rely on the member states to keep their word, and it's proven that neither China nor the US were ever terribly keen on being held accountable there. And so that is definitely a problem. And it does ripple through everywhere. Even in South Africa at the moment, we are suddenly considering national security as a reason to impose import control, for example. In other words, you need to get a permit before you can do an import. This was just unheard of before, and suddenly it's spoken of in quite normal terms.
Sure. Okay, so the walls go up. Bringing them down again requires probably more than the removal of Trump.
Oh, yes. Yes. I mean, this would be very hard to simply walk back. The problem is protectionism is politically very appealing. It's economically a nightmare, but politicians love it because it looks like they're doing something. It's a very visible thing you can see. You'll see Trump bragging about the billions that are being collected every month in customs duties, never mentioning that money is coming out of the pockets of poor and middle class people, largely in the US. So it's appealing, but it's typically very bad economics.
Donald MacKay, thanks very much. Director at AGOA International Trade Advisors, you at the Money Show, 21 after 6. Dr Kingsley Makhubela is a risk analyst and former diplomat, and in fact a former ambassador. Mr. Ambassador, good evening. Taiwan imposes this ban on the sale of microchips to South Africa and then rescinds that ban. Is this one of those moments where maybe they realized the threat of using the weapon is more powerful than using the weapon?
Stephen, good evening. To give a bit of context to this Taiwanese flip-flop position, perhaps it's important for one to reflect on the microchip industry in Taiwan. It's $165 billion business, and Taiwan has a market capitalization of 20% of the global semiconductor. And Taiwan is a big economy, about 814 GDP, and they rank, I think, 20th in the world or 22nd in the world with a population of 23. If you compare that to South Africa, which has a very small economy of $418 billion, you then start to understand why the Taiwanese are trying to flex their muscles. But you'll recall the statement issued by DECO, Stephen, sometimes in October last year. What is problematic in the statement when I read it that time and I tried to go through it again? It's DECO's statement that the relocation of the Taiwanese offices to Johannesburg has to do with the normal standard diplomatic practice. They say that the capital city is the seat of embassies and high commission. That argument is flawed. If the basis of the discussion with the Taiwanese was based on that, it's flawed because you have a country like the United Kingdom. London is both the capital of the country and it's the commercial hub of the country. So is Tokyo, so is France. You get exception there and there. Germany, it's not, Berlin and Frankfurt are serving different purposes. But I think the decision by the Taiwanese, they realized that really using the semiconductor would not move the needle because if you look at the trade between the two countries last year, about 75 million rand, 4-point-something million dollars. It's not that much. And they realize they can't use this as a leverage.
Isn't there another risk, both for the Americans with what they're doing to us and with Taiwan, that this just moves us closer to China, makes us more dependent on Beijing, surely?
You know, when the United States imposed sanction on importing the Chinese semiconductor and preventing certain technology from reaching China, the Chinese reciprocated. And this reciprocity of the Chinese has been very heavy because some of their rare earths are used in the military and so on. What the Chinese did, they set up a bureaucratic process to process their rare earths to the United States, making it much more complicated and complex. That's why, in my own view, Stephen, you'll never see this 50% tariffs imposed on the Chinese because the Chinese have a huge leverage. But you see, it has started a new precedent to operate outside the normal world trade regulations, and to work outside the international law, which are these institutions that are meant to arbitrate and facilitate trade between countries and arbitrate any dispute. So you find a lot of unilateral approaches. And I think, and I'm glad the Taiwanese realize this too early, that doing this actually is shooting themselves in the foot. Because in the process, the Taiwanese are selling to China, I think, about $50 billion a year, and another $37 billion from Hong Kong, which combined it gives 80-something billion to China. They realize that won't work.
I mean, does Taiwan come away from this looking a little foolish, or do they come away from this having reminded Pretoria of how important they are?
Well, if you look at their statement, Stephen, they are saying they are suspending this after the Ministry of Commerce consulted with the Ministry of Foreign Affairs of Taiwan. They decided to suspend this. Then you ask yourself, from its inception, were there any consultations between the two entities of government in Taiwan, or it was a unilateral decision that was taken by the Commerce Department? And it seems in this case, the president of the island intervened to say, wait a minute, folks, cool down about this. This is how we're going to handle this matter. I hope they realize that using trade as a weapon of choice, to use President Ramaphosa's word, it's sometimes misguided. You can end up shooting yourself in the foot. And in this respect, I think they were shooting themselves in the foot.
Dr Kingsley Makhubela, Mr. Ambassador, really appreciate the time. Thank you. Risk analyst and former diplomat. 26 minutes now after 6 o'clock.
The Money Show.
The Markets.
Imtiaz Suleiman's Director and Portfolio Manager at Ethos Capital. Imtiaz, good evening to you. We've been talking about the actions of the American economy in the last few moments, and despite everything that's going on around it, its GDP figures showing it's doing quite nicely.
Hi, good evening, Stephen. Yeah, I think what we're seeing is GDP numbers continue to surprise on the upside. We did have a very weak first quarter out of the US, and subsequently that has rebounded quite significantly to around 3.8%. And this brings a conundrum for the Fed because you've had very strong GDP growth, you have a weakening labor market, but also inflation that is above their 2% target. So this action and price action that we saw today was some sort of weakening in terms of the U.S. market with regards to the tech sector, which is very highly correlated to long bond yields. And we saw a bit of a sell-off on the back of lower expectations for Fed rate cuts. throughout the next 6-month period.
I mean, we keep talking about interest rates and inflation. We had PPI figures out today, which basically it was 1.5 last month, and it was 2.1 for the month of August. And in the US, it now seems there's less of a chance as a result of these GDP figures of an interest rate cut. So the picture starts to get a little scrambled.
Yeah, definitely. And that's what we've been hearing out of the Fed, that they continue to be very data dependent, and the data has been very mixed. So I think today's numbers will reduce the odds of that rate cuts out of the US, but we still see that rates should come down, but maybe not aggressively as the market was pricing in prior to today's number.
An update today from Barlow World, and they've been in the news a lot because of the sort of I shouldn't call it a management buyout, the bid by a consortium that includes the CEO to try and take it over. But it's an update over the last 11 months, and across most sectors, their revenue was down. In a way, quite surprising considering how well they had been doing for a while.
Yeah, I think it was a bit of a mixed bag, but generally revenue was down 10% on a group level. If you look at the different divisions, Equipment South Africa, which is really their CAT business, that revenue was down by 3.9%, but their margins also came under pressure. Their order book did grow, and I think what we're seeing from a commodity perspective is that the platinum group metals have been quite strong. The gold price has certainly been quite strong as well. So we should see a better next year or going forward. And then they've got a business in Mongolia and Russia, which is self-funding. Mongolia also came under pressure. So if you look at it together, some of the consumer-facing businesses like Ingrain, which is a starch business in South Africa, face some pressure with regards to higher imports and more competition. And it speaks to a very weak domestic consumption environment that we find ourselves in. But I think, as commodity prices hold up, they should see that order book growth translate into better growth down the line.
Imtiaz Suleiman, thanks very much indeed. Director and Portfolio Manager at Ethos Capital.
Oh.
WhatsApp Stephen
On 072
702
1702.
Well, I was asking you earlier, how often do you go and see how much money you owe in traffic fines? Do you pay them?
Hi, Stephen. Karine from Benoni. We check our fines every 2 months on the internet. And last week, one of my reps was stopped and told all of a sudden we have 5 outstanding fines from 2020. Blow me back. How did they appear all of a sudden?
So I really don't think that we should drift between neither America nor Taiwan or China. I would like it if we could be dependent on ourselves instead of have to be dependent on one or other superpower. That's my opinion. It's Chad.
Chad, yeah, I think you're right. And I think Azar Jammine was heading that way. We need to actually concentrate on ourselves. We need to stop being dependent on everyone else. I think that's right. I'm sorry about the traffic fines, and obviously managing reps, that can be a very difficult issue. I just get a sense that kind of no one takes traffic fines seriously. And that's a serious problem. It's a really interesting symptom about our society. And you can see it because, as you're driving right now, how often do you see someone not indicating, going through a robot that's out without stopping? All of those things really is a symptom of what's really going on.
702 Stephen is on the Money Show.
6 to 8 p.m.
17 minutes now to 7 the time. Well, a fascinating series of announcements from the Electricity Minister, Dr Makhubela, today. Government is trying to stop load reduction, where township and rural areas in particular, the network in an area cannot actually sustain the load. As a result, areas are put in load reduction. Happens often for 4 hours in the morning and 4 hours in the evening. Basically, there are many people who, whenever they're awake and at home, have no electricity. Jose Maleshe is an expert on energy and electricity and financing. Jose, good evening. So the minister says there'll be a combination of smart meters and microgrids. Okay, but this is a difficult problem. It's a very difficult technical problem. And he wants to fix all of this in a year. Surely that's a big promise to make.
Well, I was actually, I'm supportive, and I think it's a good thing that firstly they are trying to do what they are doing. But I was also surprised about the timelines, especially for microgrids and those kind of projects. But I think what maybe makes him to say that is because they are going to do the work on Eskom balance sheet. So basically what they're going to do is to implement smart meters, which indeed have been proven to turn around payments in the long run. And this is because they think firstly, they are owed almost 100 billion by municipalities, and they've not been making progress over many years of trying to address that. So they think that the smart meters can turn around that. And also in terms of the fact that right now, when they do load reduction, they impact everybody who's within that vicinity, whether you're a paying customer or not. That it becomes a problem. So they are trying to make sure at least if they are not giving you electricity, it's because you are the one who's not paying. So the intentions and all of the objectives are all good. However, there is an issue in terms of whether they can meet those turnaround times.
Well, I mean, Jose, I'm reminded, I hate to be this guy, but there's a local election in a year's time, so that must be a factor in all of this. Okay, so there are a few things. If you put smart meters in the past we've seen in some communities when you've put prepaid meters in, there have been protests and often violence. Parts of Soweto, this has been a big issue. And I would imagine in communities, and I've never lived under load reduction, I've obviously lived through load shedding, but people might be inclined to think, well, if this is going to end load reduction, I'll happily accept the smart meter because that means I'm going to have electricity again.
Yes, if you are not the one that is connecting illegally, you will think that. Because if you are part of the group that is connecting illegally, you want the status quo to remain. And I think I like the fact that they did a proper analysis to say 80% of the areas that have load reduction seem to be in particular areas. Gauteng, I think, said 38%, and then there's Limpopo. There's five main provinces where they think they're going to have problems. And then a few other provinces, 20% of it, they think that's going to be easy. So at least they've got a plan that is methodical, whether or not they meet those timelines. But you're right. In terms of certain areas, they are saying subject to us not meeting resistance. And we know that they will meet resistance in those areas. Yeah.
When I hear the phrase microgrid, because that's the other point of this plan, my assumption is that Eskom is not a part of that. Now I might have that wrong, but if that is the case, they're going to solve load reduction by cutting Eskom away from paying customers. And isn't that bad for Eskom?
I don't. So there's a challenge with respect to the fact that we are supposed to reach 100% of access to electricity, universal access by 2030. We have done a lot, made a lot of inroads since 1994, but we still have not reached that level. We're around 80%. So I'm assuming that he's talking about the areas that are very far from the grid and not connected to the infrastructure, and therefore would like electricity of any kind. I think he made an example of an area, I don't know if it was in Zanin or whatever the area was, where they've now already done a pilot study where they are combining all these small-scale projects and doing that. So that will be a non-grid or off-grid solution.
There's been other developments in electricity today, Jose. I mean, there was confirmation Investec now has an electricity trading license. Investec, last time I checked, was a bank. Vodacom has now created a virtual wheeling platform so people can generate electricity or buy electricity in Musina and use it in Cape Town. They're a cell phone network. Why are they getting involved in electricity trading? I mean, are numbers, cell phone networks, banks and electricity going to become kind of the same thing?
Well, this is all about how sophisticated you can be, because these are all happening in terms of an electronic framework. So you are not really building infrastructure as Vodacom, but you understand networks. and you understand the Internet of Things, if I can put it that way. So in that sense, you are then don't have to be an IPP. You could be getting this from people who have the capacity to develop it, and all you do is to have those transactions with them to sell to you. And then that portfolio you would be able to combine together. Probably as a price taker, you'd be able to get a good, a reasonable price, and then be able to compete in the market in that way.
Jose, thanks so much for the time. Jose Maleshe is, of course, the expert on electricity and energy and financing as well, which is really where the story is now going, I think. 10 minutes to 7.
The Money Show, Stephen Grootes, is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country.
8 minutes to 7, the time. Good to hear from you on 011 883 0702 and 021 446 0567. Ethos Capital reporting today their net asset value per share up by 30% in the year to the end of June. Their main investment, it's in the fintech firm Optasia. That grew by over 50%. The company says its other assets also grew. I'm happy to report that Prime Media, which owns this radio station, is one of them. Anthony De Beer is the CEO at Ethos Capital. Anthony, good evening. Optasia offers micro-lending, airtime, credit, things like that to people across most of Africa, some of the other parts of the world. It's clearly realizing big value for you.
Yes, thank you, Stephen. Good evening. Optasia Investment's really been an outstanding performer for us. A lot of work's gone into that asset since we invested in 2019 into it. And it really shifted its business outside of pure airtime credit into microfinancing solutions. And it also started expanding across geographies and territories in emerging markets. It now operates in 38 countries across these product offerings that I mentioned earlier. And really, it's been growing in dollar terms substantially over the last couple of years. So we're very pleased with this asset. It's an asset that creates scale quickly. It generates a lot of earnings and a lot of cash flow growth quickly. And it's been able to really, through technology solutions, been able to provide credit scoring solutions that provide services that have been outstanding for us. So very pleased with the investment, and we've made a lot of progress with it over the last couple of years.
There's a lot going on in the fintech space at the moment, obviously. There's huge momentum. Are you expecting a lot more growth in the year ahead?
The total addressable market in the lower end of the market where we operate, there's certainly complete underbanking taking place in emerging markets, and we're a beneficiary of this. This company, although there's a lot of competition, I think that there's still a lot of way to go for it. I think that on the microfinancing side in particular, it's completely underbanked. So I still see a huge opportunity across emerging markets for this.
Prime Media's EBITDA was also up. We're not your biggest investment, obviously, Anthony, but that must help as well.
Yes, it does. Yes, it does. I mentioned earlier today that I guess your boss, Jonathan Proctor, has done an outstanding job over the last couple of years, really driving that business from a COVID low point and expanding its offering and taking very good market share. So very pleased with that investment and the progress that they've made there.
I better remind him once a day about that, see how it works out for me. Your share price is still trading at a discount to your intrinsic value. That discount's become much lower, of course. It's around 20% at the moment. Do you think there's scope to reduce it further?
I think typically most of these vehicles trade somewhere between 20 and 25%. We were as high as 40 to 50% at some stage. So brought that discount, the share price responded and brought that discount down quite a bit. But Stephen, unless we convert our investments into cash and return that cash to shareholders, there will be some discount to that underlying NAV. So we're working hard on our realization strategies for the various investments. We continue to be successful at it. And then the big thing for us is to return the capital to investors. So we've announced today also the unbundling of the Brait exchangeable bonds that we own. We will give that back to investors, thereby effectively giving that NAV back to shareholders to decide what they want to do with the Brait exchangeable bonds. And as we monetize assets and turn it into cash, we're effectively crystallizing the NAV. So I think the narrowing of that discount is a function of successful realizations this year and giving that money back to investors.
You have some other companies or stakes in other companies that I get the sense you might like to sort of get rid of, to dispose of. Is it, I mean, how easy or how difficult is it to do that at the moment? Is there a lot of interest in companies that are sort of South African owned? Are there people who are willing to take them off your hands?
Good assets sell themselves. That's a sort of a cliche in the private equity space, that you don't struggle to sell good assets. I think for us, it's important to remain disciplined and make sure that we keep building assets in a manner whereby it's attractive for a variety of investors. So our aim always is to keep working the value in assets, keep driving it, keep strategically positioning them so that they ultimately can be disposed of to either financial buyers or to trade buyers. There's been a lot of interest in the last year. You would have seen that we realized just over 600 million through various underlying portfolio companies, and that's a testimony to the quality of the assets and people being interested in it. I see that continuing for a while, and we'll just keep being disciplined and patient and sell assets when it's due. We not a forced seller ever of any asset. We wait patiently for the right moments.
Your end game is to delist from the JSE. Any updates on that timeline? How long it might take?
No, the Optasia asset makes up more than 50% of our NAV. So I think rightly it's important that we make the right choices and decisions around that asset when that realization comes to bear. Then I think as far as the rest is concerned, it will become a really small cap on the market. And we've just seen that investor interest then wanes completely, and you've got to do something with it. So I think once Optasia has run its course, I think it will then be time for us to think about the next step. And delisting is the obvious route then.
Anthony, thank you very much indeed. Anthony De Beer, CEO at Ethos Capital.
WhatsApp Stephen
On 072
702
1702.
So consumer confidence numbers were released today, and it's in a way a kind of dipstick into how the middle classes are feeling. And I've been thinking a little bit about this because there is some economic data that suggests we should all be feeling just a little better than we are. So inflation is down, interest rates are heading down. If you look at the actual numbers, the amount of money going into your actual account, that's going up slightly. Salaries are slightly higher, all of those things. So then why is sentiment down? And then I wondered if maybe the built environment in which you live is a factor. And let me just explain what I mean. Is that over the last 10 years, in most of the country, we probably have started to see more potholes, more things like that. So yes, load shedding is gone. There is load reduction, as you heard earlier. But if you're driving around in an area where the light bulb, where the lights, or the late nights the lights don't actually work, and you're actually in a situation where you have potholes, and crucially, you actually think, well, it's not going to get better, well, then maybe that brings down your sentiment. We actually have a voice note on this tonight.
Hey, Stephen. The socio-economic conundrum here is you get late waiting for an e-wallet of a borrowed 200 rand for petrol to go and earn a 500 rand somewhere, and in that process get a speeding fine of 1,000 rand, which if you pay, you don't have livelihood at least for the next 3 months. Norman in Kempton Park.
Norman, you are exactly on point. I think that's exactly how people feel right now. The idea that, yes, the numbers are ticking up, but actually the way in which we live, where we live, how it looks, but crucially, the fact that there's just no sense it's getting better. I think that's what's bringing sentiment down. So Norman, yeah, you're on point. You're with The Money Show. It's 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country. Good evening. Plenty coming up in the next little while. We'll speak to Siphumelele Zondi, our tech expert, in just a moment. Artificial intelligence, everyone's talking about it, but Google seems to be buying it pretty much. We'll talk about that. Zanele Matoma, she's already sitting outside in our waiting room, the founder and CEO of Welo Health. We'll be speaking to her. She's been trying to cut work absenteeism. I don't know how many times you or someone in your family, someone you work with, how many days you might have lost just queuing to try and get some help from a government clinic. Well, their aim is to kind of deal with that. We look at that in Small Business Focus. And then IPO 101, what you need to know before you buy into a firm that is actually now going onto the stock market. And one of the things I've noticed in my sort of short time watching the JSE is how newer firms, newer entrants to the JSE seem to go up and down so dramatically when they arrive. And it's not just big companies like Boxer, it's smaller ones too. Some of them, it's just incredible. So we'll talk about that on Investment School this evening. Good to hear from you. 011 883 0702 021 446 0567. And of course, voice notes tonight on 072 702 1702.
The Money Show, Tech Thursday.
Well, I don't know if you remember when social media started and you had companies like Instagram and WhatsApp, and suddenly they were bought by Facebook, which became Meta. Now, it seems Google might be doing that with AI, or certainly trying to. Siphumelele Zondi is our tech expert. Siphumelele, how's it? It's been a little while. Good to talk again. So NVIDIA, they make the chips that you use for AI. They're working with Google. Others are too. What are they all working on?
Welcome back, Stephen, and yes, thank you very much for inviting me again. Hello. So they're working on a number of things, right? Because it's sort of like a ramping up AI that's especially coming out of the global north, because China has been seen as a threat to this. There are also projects that they're working on, not just in the United States of America, but in Europe as well, because it seems like there's this belief that Google has a lot of information, and maybe it does because of its existence that dates back to the last 20 years, in terms of images that are being used, in terms of the information that goes through Google. And so a lot of these smaller companies would, in a way, utilize Google's systems and the information that Google has in order for them to develop their systems. And NVIDIA and other companies are also trying to tap into that. But we also know that NVIDIA is the world's most developed and fastest chipset that's being used in artificial intelligence at the moment. So that's where the benefit is with this particular collaboration. And other companies are coming into some of the other projects that they're working on. Microsoft as well has come into certain projects that they're working on in Europe with this partnership. So it's basically information sharing with them, and with all the technology that they have that differs from the tech that each of the partners would have.
I mean, could this lead to some kind of merger? I mean, you know, in ordinary circumstances, you say a takeover, but I don't think even Google could buy NVIDIA at the moment.
Probably not with the big companies, but Google certainly has had shown an interest and even invested in some of the small players. Think about Cypher, for example, which is a company that in a way invests in a cryptocurrency, and Google has bought a 5.4% stake there. It often starts that small a lot of the time with a small stake, and we're not sure how big it's eventually going to grow into. And they've, for example, have been trying to buy Windsurf, which is another smaller AI startup. But it seems like with the latest, they eventually did not buy Windsurf, but they decided to poach some of the people that are running Windsurf to move over to Google and bring some of those skills that they're coming from the smaller AI startups.
In the past, when, you know, a WhatsApp or a Instagram would get bought, they'll get a lot more money, and that would be good for them. There would be a lot more investment. What happens when Google takes over AI development companies? I kind of want to think, well, that would be good for them, except I'm also reminded of DeepSeek, which was a kind of different story.
So when you think about it, is that they often get swallowed up and then it changes into something else. Think about Twitter, which became X as well, where a lot of people now are complaining that it's not doing what it used to be, what it used to do. There was in the beginning, before Elon bought it, he said he had an issue with the number of bots that were being allowed to use the platform, but it seemed like those had been removed. But it seems like they're back, and it seems like they're back in massive numbers, and it seems like they're utilizing AI even when they share some of their commentary, and you get the sense that you're not really even interacting with something that's run by human or that has any human or much human involvement. And also now the where you find Grok AI being embedded as well into what has become X, which used to be Twitter as well, where a lot of people, if they need information, you no longer ask the general public that would be using X. You'd be asking a Grok, an AI tool, to give you some of that information. So it could be, I suppose, depending on the AI development, could be good or bad, depending on the direction things go.
I mean, the other thing is that companies like Google have always said, because innovation is so ferocious in the tech space, you mustn't regulate us because in 10 or 20 years we might be gone. But that won't be the case. They'll be able to re-entrench themselves.
And it hasn't been the case because it almost seems like when you look at how companies, for example, are trying to follow issues of legislation, because these tech companies move so fast and you find that they are so far ahead eventually, and the tools that they create of humans, of governments, and you find that they don't really disappear because they hold so much information, and they've moved so far ahead that it's governments that end up needing them as opposed to them collapsing. So that's where the regulation of these sales, I suppose, comes in, of these AI tools comes in. And you may think of, for example, American President Donald Trump, who's even put his foot down with where some of this information is coming from and who must buy what. But maybe there can be that regulation in terms of if it's done well. So they don't have so much power that they essentially are running the world, you and I, and how we even live our lives.
I mean, this is, in the end, becomes about the consumer experience, right? And when you have takeovers in a few small actors, that can lead to really good competition and a good experience for the consumer. If you have lots of actors, that can be quite diffuse, quite frustrating, not so good for the consumer, but also means there's no dominance.
Well, yes, but also you may think that if you have, for example, many players, let's go back to social media before social media was also consolidated. Think about how Facebook bought WhatsApp and Instagram. Before it got consolidated, you had, you may think that you probably would have had multiple options. They work differently from one another. You could get a variety of different information. But when they then consolidate information, because they're sharing information, they're sharing the tools, they're sharing the knowledge, you might find that you think you have options, but do you really have those options? Because if you get into one tool, that tool is going to operate in more or less the same way that another tool is going to operate in. But at the end of the day, while the consumer might worry about that, the collaboration is good for the companies that are sharing this information, because for them, they get to develop faster because of the sharing of information.
Siphumelele Zondi, thanks so much. You tech experts. Fascinating how all of this is moving. 16 after 7.
The Money Show. Small business focus.
Well, I'm sure you're aware of how long it can take to get proper healthcare from a government clinic. I mean, some of the stories that you hear are horrific. People waiting in lines for hours and days, and I'm sure sometimes weeks. You queue from 4 a.m. or even earlier. You have to give up days of work just to get some kind of treatment. Well, one small company is trying to sort of help companies around all of that. It's called Welo Health. The CEO and founder is Zanele Matome, and she's in our studio now. Zanele, good evening. Thanks for coming in.
Thanks for having me.
How does it work? So you provide some healthcare services of your own for a sort of monthly fee. How does the service work?
So Welo started in 2020. And when we started, we were just delivering medication. We will pick up medication for people who use public health care. Pick up medication for you so that you don't have to queue from 5 a.m. up to 2 p.m. and just deliver to you. So, and then we grew to servicing SMEs and corporates, etc. So this new package called Welo SME is a package where now we took all of our learnings and our three top products, which is now medicine delivery, chronic medication delivery from public health care to your workplace, digital doctor consultation using WhatsApp, because we all on WhatsApp groups, be it gogos or estate people who are always fighting and all of that, but we all on WhatsApp groups. So you consult with the doctor on WhatsApp, you get your script there, you get your sick note there, instead of going to queue and go to the public hospital or public clinic. And then the third one, part of that package, so it's three things. The third service is now when we say a nurse comes to the workplace for the employer to come and do screenings. So the screenings will range from your high blood checkups, cholesterol, HIV, etc. So that we preach preventative. And for that package, you as the employer, so it's for 6 employees up to 1,000, etc. So you as the employer, you will pay 385 rands for your employee to get that package. So some of our clients will say, okay, I'll go 50-50 with my employees, subsidize them, or I'll just do the whole 100%. Okay. So that's Welo SME.
So I have to, I mean, I can just see the lawyers here. How do you get a sick note when the person, I presume the clinic doesn't actually see the patient?
Yeah, so with the sick note, there's the digital doctor consultation. So you will be consulting, or your employee will be consulting with the Welo doctor.
Right.
That's when now the sick note will come in digitally. We'll send the sick note to the employee and to the employer. And the great thing about that one is that usually with sick notes, I used to be in mining where I had my small contracting company. Month end, Mondays, long weekends, etc.
Yes.
People will come with a sick note, and the doctor address will be somewhere in Elof Street. They know I won't go there and check if that doctor exists or not. But now with Welo, we using our Welo doctors. So we are offering your employees our network of Welo doctors. So yeah, so we get around those things, those loopholes.
Okay, so the doctor will know not to just say the person says they have a fever. I actually need to see evidence of it.
Exactly, because they're not friends or related. And yeah, so yeah, and the doctor is not at Elof Street where we don't know where to find him.
You speak with some experience, Sanele. So what kind of companies are signing up for this? I mean, you're aiming it squarely at the SME market. It's not a huge amount of money a month, and I suppose for some people, particularly people who maybe have a chronic condition, it saves them so much time.
It does. So I'll start with the first question. The type of companies that are signing up would be like your restaurants. We've already signed up a few restaurants around Joburg, where they have like your chef, your support staff, your salons, a saloon with 6 employees. It will be as far as your enterprises, like your factories. We have a client that runs a factory in Joburg CBD. They have 500 employees. So anything from 6 up to 1,000 employees around South Africa. We service you as far as Kuruman and Hot Hazel in the Northern Cape, because we've been building that capacity and that database of nurses, doctors since 2020.
I mean, I tell people Hot Hazel exists and they don't believe me.
Oh, man.
It's quite bizarre. So, I mean, what you've discovered really is a sort of gap in the market. And the gap comes because of a failure of a government service. So how do you then make sure you get the service? Now, I get that obviously one person can go and get 20 scripts, okay? So so that's already 1/20th of the time saved for each person. But I mean, do they have to fight their way in a queue? Do you only employ people with sharp elbows or something?
No one has to fight their way. That's why we established this product, so that we eliminate queues, all the stresses of queues. So we do have, because we merge technology and human touch, that's why we are a health tech company. But we say, because we in Africa, you cannot go 100% digital. So we have our humans who do the other parts of the messy parts, but there will not be any queuing for our clients.
Do you find that people are very interested in this? I mean, do you think they're seeing the value of what you see yourself as offering?
They are interested. We even now have a wait list of individuals now. And we're like, you know what? This is a big elephant. We want to chew it face by face because we're building a global company, we're building to last. So at the moment, we have like a wait list of 8,000 Stokvel members who has been knocking on our doors, I think, since last year, saying, we also want this for our Stokvel members. Or you will have El Rato who stays in Sandton and say, my mom is in the Eastern Cape. I don't mind paying for this because this is much cheaper than your usual medical aid companies, etc. We are not a medical aid company. So we do get people knocking on our doors, but we're like, okay, for individuals, not now. We're only dealing with SMEs and we just roll this out face by face.
I mean, the joy of working with SMEs is you know you're going to get paid.
Yeah, exactly. We won't have to chase anyone for our payment.
Okay, so how many people are you employing at the moment? And I'm trying to think, you'll have some doctors, you will have some nurses.
Yes.
You will have also people who, I presume, go to clinics and get the medication.
Exactly. We call them our runners. So we have runners in South Africa. We have around 150 runners for now. And then we had a network of 750 nurses. The nurses are, so all of this is based on a gig model.
Yeah.
Because you want to be as asset-light as possible as a startup. So we have gig nurses. It will be nurse Lerato, who works at a public hospital, private hospital. On their days, the days that they are not working, that's when now they get an opportunity to make extra money. We have paramedics as well. Paramedics, we added them this year when we started working as far as Cape Flats, your Alexandra and all of that. And some of our nurses were like, it's not safe to go there. And then we started hiring male paramedics as well. And then we have a network of doctors. So a doctor will be a Dr. Dutoy who has their own practice, and then they will say, okay, for 2 hours, I'll allocate it for Welo Consult. So it's a gig economy model. Hence, we can scale across the country.
You did say in South Africa, do you have some workers outside South Africa? Because
yes.
In some ways, the nursing and the sort of stuff that's happening digitally, you don't have to be in South Africa for.
Yes, we do, because we operate not only South Africa, we operate in 6 other African countries: Mozambique, Malawi, Botswana. Botswana is close to my heart because I grew up in Rustenburg, so
Yes.
I feel like it's home. So Botswana, Malawi, Mozambique, Lesotho, and all SADC countries except Namibia for now.
It's fascinating. Growth, I mean, the prospects must be huge, and you're going to face competition when you do it.
Yep, there is competition. There's already competition. But what I love about this ecosystem or the competition is that I feel that we complement each other, because this is such a huge market, not only for South Africa, but Southern Africa. So when we complement each other, that's when now we speak more of collaboration rather than competition. So there is competition. There are good players out there who are doing amazingly in terms of innovation and access to health.
Zanele, thanks so much for coming in. Really appreciate it. Zanele Matome is the founder and CEO of Welo Health on Small Business Focus.
The Money Show.
Investment School.
24 minutes now to 8 the time. Well, from time to time, you'll hear about an initial public offering, the first time that a company is going to be listed. And there's often so much excitement. I mean, last year, the big story was Boxer. Do you remember when Boxer was listing? Everyone was talking about it. Sometimes companies will list on the JSE with a little bit less excitement. They might be a bit smaller, for example, than Boxer and less well known. But the joy of investing in an IPO is that you might be in a position in which the value is going to grow. And so it's incredibly attractive, but it is also brand new. So you also need to be quite careful of that, because you can still lose money. So how to invest wisely in an IPO is your subject this evening. Vincent Anthony Raja is the CEO and co-founder at Differential Capital. Vincent, good evening. Thanks for coming back to us on Investment School on the Money Show tonight.
Thanks for having me, Stephen. Good evening to everyone.
Okay, so you hear about a company that's having an IPO. They're listing on the stock exchange. There's a lot of excitement. There's a lot in the sort of business media about it. What do you need to look for before you make a decision about whether you should get involved in this or not?
Well, I think the first things that you need to start off with are your traditional appraisal criteria. I mean, you first need to understand whether this is a company. Forget about the IPO. You'll need to understand whether this is a business that it's fundamentally sound, whether you'd be investing it if it was listed already. So the IPO often creates excitement. It creates potential for FOMO, in the sense that you're not currently an investor. it's an asset that no one really generally has access to. But it's important to put those feelings aside and really look at the company fundamentals. So, what does the company do? What competitive advantages does it have? What are its growth prospects like? And then assess that first before you dive in. And there's a number of other useful things that you can know, try and find out around the IPO, which is, why is the company looking to list? Is it looking to raise more capital? What does it want to do with that capital? Or the more perhaps one that you need to be really cautious about is, is our existing shareholders looking to exit? And why are they looking to exit? Is it a private equity firm that's looking for liquidity? In which case, could you be potentially buying at a very high valuation? And those are the things that you need to consider on a secondary basis.
I mean,
don't know if that's
yeah. It seems almost as if the reason why it is being listed is almost as important, actually, as the underlying value of the company, because that tells you what the people who currently own it are expecting the future of the company to be.
Yeah, absolutely. And, if I take the earlier example that I gave you, if the company is looking to raise capital for growth, for expansion, those are often good signs. It's the company just maturing through its growth cycle. If you think back to Meta, or what was then called Facebook's listing at the time, to go back to the likes of Amazon, those are growth-hungry or capital-hungry businesses that went past the private phase and needed the broader capital market support to take it to the next level, whereas then you sometimes find other companies where private equity investors, having gotten early, are looking to exit, and sometimes that is a bit of a red flag. Particularly, and the thing that you need to check for is also if the founders and earlier investors don't have what's called lockup periods. In other words, a few weeks after the listing, they can start selling their shares in the market. That can be often quite problematic.
I mean, the other thing is that with the big examples, and we use the big examples because we remember them, of Amazon or Facebook, there's a lot of transparency. I would imagine most IPOs on the JSE, some of them, like Boxer, will have that level of transparency, but a lot of them won't.
Yeah, I think Boxer is a great example because that's one where the business itself was known. It was inside another listed entity. So it's a great example of capital restructuring where the parent company needed capital, still wanted to remain a shareholder. So all of the signs of, let's call it, a positive reason for listing that business were there. There are also negative reasons. And, unfortunately, in my earlier investment banking days, I was involved with a few of those where, perhaps there was a company that privately was in a lot of financial distress and needed the capital markets to sort of bail it out. And while the assets may have been sound, let's call it, the management team weren't incentivized for long-term sustainable value creation for shareholders. And, going back to that example I told you about lockup periods, I mean, I still feel really bad when I think of one of, this sort of senior portfolio managers out in the market who shouted at us because, the lockup period wasn't long enough. And, it's as one would expect, as soon as that lockup period expired, the management team started selling their shares. And that didn't end well at all. I mean, a few years later, the company was in a lot more trouble than before its listing,
So often when you're looking at an IPO, there'll be a prospectus. So it's a sort of, what is this company for? What is it going to do? And I am sure, Vincent, I mean, I've never met one of these people, but I'm sure they exist. There is an art to writing a prospectus. Someone probably does this professionally. So when you are reading a prospectus, would you expect to find all the answers to the questions you've posed there?
You've got to read a prospectus very cynically. So there'll be plenty of information there. But you can rest assured that, let's call it even the good IPOs, the good opportunities, will always present the best foot forward. I think a sign of a healthy IPO is one where there's enough of a reasonable section on risks. And there you get a good sense of the management team's ability and their own perception of risk. Where you find, let's call it that the narrative in the IPO is greatly skewed towards the opportunity, and let's call it a less than reasonable appraisal of the risk. I think that's where your sort of cynical antenna needs to be at its highest.
Okay, so I like the idea of just reading it cynically. I mean, that makes a lot of sense to me. The joy of an IPO, and people will always think of the big successes. So, I think I used the example on the Money Show a few months ago that, everyone would think, well, if I had invested in Capitec when it listed, I would be very rich now. But if I had invested in Capitec 5 years before it listed, I'd be even richer, right? So timing really matters. And the idea for a lot of people is an IPO would be the first time you can get exposure to a company. And so that, I presume, shows you how important the timing is. And you use the word FOMO, fear of missing out, a little earlier. And isn't that what kind of drives the excitement around these things?
Definitely does. And what that tends to do is, even for good companies, that FOMO and depending on how broadly the stock will be issued, because you've got to be careful. Sometimes with IPOs, if there are other preferred large asset managers in front of the queue, they might get a better allocation than yourselves, and that tends to cause a bit of a squeeze for the price. And what happens is, on listing date, the price is probably artificially high sometimes. And that's where, you often find that IPOs, it is quite common for them to underperform quite badly. Not that the company itself is bad, it's just that the pricing at that point in time might have been overhyped. So, investment banks are highly incentivized to try and get the best price possible for their client, which is really not you, the investor. It's the company and those looking to list their equity. So you have to be, that cynicism is important in IPOs, and you've got to be really careful. So one of the examples that we often do is just check the extent. If you go back to the Boxer example, and the reason I'll bring it up, it's a good one. At that IPO, it was quite reasonable because Boxer was growing faster than ShopRite, had better margins in certain aspects, and therefore the price to earnings multiple that was being requested was really reasonable. Compared to other comparable businesses. When you find that the valuation metrics being asked are stretched and require growth and lots of things to go right, that's when you need to be very careful.
That's very interesting. So that issue, and you made the point that the price can sometimes drop quite dramatically after the IPO. And I've seen this. I mean, there's a good example of ASP on the JSE at the moment, where the valuation can swing so wildly. And it's not the only one. There've been one or two others I've noticed. On the first day, it sort of is off and up dramatically. The next day, it's down dramatically. Why does a share that is new to the JSE often swing so wildly? And I must say, obviously, Boxer swung a little bit, but then calmed down quite quickly, and that was probably because the value of it was known so well. But why is there this sort of wild phase in a share price of a relatively newly listed stock?
Look, to be fair, Stephen, even Boxer had a wild first day, I remember. I mean, there was big swings. So even with a stock of that size, of that magnitude, what you often find squeezing the price up is, especially in the case where there's lots of demand for that asset, you'll find that many investors were left out or didn't get the complete allocation that they wanted, and then they end up just squeezing the price up aggressively. What you also find on, and this is the case sometimes, is there are specialist funds that short, so once a stock has IPO'd and there's scrip available to borrow, you do find there are strategies that are out there that, if the criteria is right, they'll short it. And again, because the stock is new, because a big part of the shareholding probably isn't most confident, and they've probably bought what they needed to buy. Therefore, if the price drops, 10 or so %, you won't find that there's support in the market to pick up the shares because everybody's kind of had their fill. It's those kind of events where you just need to be guarded about, especially where there's a lot of unknowns. So I guess that kind of volatility is more of a reflection of when something's really new, hasn't really been understood before, it takes a while. So, if one takes a look at ASP, it's not the most well understood company out there, contrasted to Boxer, which was well understood primarily because it was a division of Pick n Pay.
I mean, it's amazing that there are people whose model is to short a brand new stock. I mean, I realize that all's fair in love in the JSE, but that's rough.
Yeah, it is rough. And that's the JSE. I mean, you'll find on the global exchanges, it's far more aggressive. One has to think about Uber's IPO, which also did quite badly for a while after listing. So again, there are, funds out there that do that when something is hyped. And there's certain signs often where, especially as you get closer to the expiry of lockup periods, that's where these issues can arise. Sometimes you even find that if there's a founder involved, when they IPO, sometimes you might find that they have these collar structures in place which protect them against the downside. But what it means is there's a bank somewhere that actually needs to short as the share price drops because they provided the guarantee. And it's these kind of structures around IPOs that one has to be very careful of and wary of.
Here with Investment School on the Money Show, your questions for Vincent Anthony Raja, the CEO and co-founder at Differential Capital, looking at IPOs, so a company listing on the stock exchange, an initial public offering. 011 883 0702 021 446 0567. Voice notes as well for Vincent on 072 702 1702. It's 10 minutes to 8. You with the Money Show.
The Money Show, Stephen Grootes, is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country.
The Money Show.
Investment School.
8 minutes to 8 the time on The Money Show this evening. An Investment School, an initial IPO, in other words, an initial public offering. So it's the first time a company is listing on the stock exchange. When should you get involved and when should you not? Vincent Anthony Raja is the CEO and co-founder at Differential Capital. He's taking your questions too on 011 883 0702 and 021 446 0567. Vincent, I've been sort of scratching my head a little bit as I listen to you talk about the kind of danger of it and the excitement of it. It would seem to me that really it might be much safer, depending on what kind of investor you are, how aggressive you are, that actually you should basically invest in an IPO about a month after they actually list. You'd have a much better picture of where you are with all of the things you've been talking about.
Yeah, I was actually reflecting on that, Stephen, is that for the retail investor, the problem with an IPO is that you're often at a severe disadvantage when it comes to information. So often the only piece of information that you have is the prospectus. And you'll find that institutional investors, especially around IPOs, often have access to curated analyst reports. So you might find that the company appoints 3 independent stockbrokers to write research about the company. And that gets sent to a select group of investors, and that's not open to the public. Now, this advantage, is often given to big investors so that they can anchor the IPO. So, in other words, what happens is, people that come in and underwrite the IPO, as an example, or anchor it, often get sometimes preferred pricing. They often get a fee, but importantly, they get information well ahead of the rest of the market. And to compete against that is kind of difficult. So while an IPO might be anchored by a lot of large investors, there's also often large investors that have sat this one out, but you don't know the reasons for that. So, I would often say, unless you've really done the work and you've got an advantage in terms of understanding that industry, which many retail people do, you might find that it's an industry that you understand the competitive landscape, then that's fine. But if it's something that is, beyond your general understanding, just be a little bit cautious. And I think you're right, often better to sit it out. And even if the stock continues to run and you miss out a little bit, it's not the end of the world. You don't have to buy it at the absolute bottom,
I mean, it's just a reminder, and you and I have had this conversation, we've had it many times, about how you need to sort of try and be as unemotional as possible in making these decisions, because everyone's talking about this, it's exciting. The thing about an IPO, which other shares don't have, is that there's actually an event at a certain time. There'll be a CEO grinning proudly with a team at the stock exchange, actually doing something. I mean, it's very exciting.
Yeah, correct. And you have to park that FOMO. That's the most dangerous thing. And at the same time, be cynical, but realistically cynical. I think often, again, because you're on the wrong side of the information matrix, the insiders, the current holders, they know. So you've got to always ask, why are they selling, and have a healthy dose of cynicism. It never hurts.
The thing is, though, you might have, say you take part in an IPO, you buy some shares on the first day, the share price drops, and then, again, you actually still don't know enough about whether to keep those shares or not. I could see the advice coming the other way. Hang on to them for another month, because the short sellers will have gone, all of the things will have been fleshed out. So I'm completely with you on the need to be careful, but an optimist could argue it the other way too.
No, sure. That's why I said, cynical, but it must be a healthy level of cynicism. And when you do invest in IPOs, you should have that discipline. Firstly, keep some powder dry. We know that most IPOs underperform in the short period afterwards. And if you're comfortable and you understand the prospects, and understand that even the IPO price is reasonable, and at some point the market will continue to reward the share, then you can use those devaluations to increase your holding steadily. And that's why, if you go back to what I was saying earlier, if you understand the valuation relative to the peer group, etc., at IPO date, you should have a range of price. It's not the one price or the IPO price that you should, hang your hat on to. You should know that there's a level below that, or there's a range at which you'll feel comfortable to keep on buying. And that's why it's important to keep your powder dry, because once you've made the decision, and you're comfortable with it, and nothing has changed other than the price dropping, then you should use that opportunity to continue to increase your position.
And there is a risk to missing out, right? You can actually miss out if you're not careful. If you just say, I'm never going to do an IPO, you will lose out in the end.
Yeah, absolutely. And that's why I say, there have been, and here I think I must, give some credit to the regulators. I think while the JSE gets flack on sometimes, I think the amount of regulatory due diligence in bringing an IPO, particularly to stock exchanges like the JSE, it should give you some level of comfort, and that's an important thing. So I think, like I said, your cynicism should be healthy, and there are definite examples and a lot where just being too cynical on IPO is not the right investment decision.
Vincent Anthony Raja, thanks very much indeed. Really do appreciate it. The CEO and co-founder at Differential Capital on your investment school on The Money Show tonight.
The Money Show, Stephen Grootes, is brought to you by ABSA CIB, banking on local growth with Club Med South Africa to bring the first resort of its kind to the country.
US indices still down tonight, mainly because of lack of optimism in interest rate changes. The Dow Jones is down 0.45%. The Nasdaq is down 0.71%. The S&P 500 down 0.2%. I think the market just really trying to understand what the Federal Reserve is going to do next. And of course, it's under intense pressure from the US President Donald Trump as well. Trump is still dominating the news pretty much here, there, and everywhere at the moment. Well, we'll be back with you tomorrow for the Friday edition of The Money Show. Plenty to come then. Plenty to come with Aubrey as well. So do stay listening with Aubrey Masango. He takes over in a few moments. Good evening. It's 8 o'clock.